Assalamu alaikum and hello everybody. Let us start with the IFRS 18 presentation and disclosure in financial statements. Right. First thing first, what's the scope of IFRS 18? Any entity, that prepares financial statements according to IFRS's accounting standards should apply IFRS 18 to present and disclose financial statements. Okay. So, uh-oh. Yeah, so the scope, any entity that prepares financial statements in accordance with IFRS should apply IFRS 18 to present and disclose financial statements. Okay. So, what is the general purpose of financial statements? General purpose of financial statements are particular form of general purpose financial reports that provides information about the reporting entities, assets, liabilities, equity, income, and expenses. Right. So, general purpose is to provide information about assets, liabilities, equity, and expenses. So, general purpose financial statements are reports that provide financial information about a reporting entity that is useful to primary users in making decisions relating to providing resources to the entity. For example, the decisions about buying or selling or holding equity and debt instruments, providing or selling loans and other forms of credits. Okay. So, another general purpose is to provide information about information For example, buying, selling, or holding equity. And debt instruments. Providing or selling loans, and other forms of credit. Now, what is the objective of IFRS 18? Well, the objective of IFRS 18, that is the presentation and disclosures in financial statements, is to set the requirements for presentation and disclosure of information in general purpose financial statements to help ensure they provide relevant information which should be faithfully represents an entity assets, liabilities, equity, income, and expenses. Right. So the objective is to set out requirements for the presentation and disclosures of information in general purpose financial statement to help ensure they provide relevant information that faithfully represents assets, liabilities, equity, income, and expenses. Right, so far, so good. I hope it is clear till here. And let's move ahead. So the objectives of financial statements is to provide financial information about our reporting entities, assets, the liabilities, the equity, the income and expenses that is useful to users of financial statements and assessing the prospects of future net cash flows to the entity and assessing management stewardship of the entity's economic resources. Okay. Now, what's the complete set of financial statements? Okay. A complete set of financial statements includes a statement of financial position at the end of the period, at the end of period, statement of performance for the period, either a single statement of profit or loss and another comprehensive income, or two separate statements. Okay. A statement of performance for the period, either single statement of profit or loss and other comprehensive income, or two separate statements. Statement of changes in equity in the period, statement of cash flows for the period, comparative information relating to the preceding period, and a statement of financial position, a statement of financial position at the beginning of period. That means at the start of the period, okay, at the start of the year, if any changes in accounting policy accounting policy is changed, or a period or a prior period error is corrected. So these are the collectively referred as the primary financial statements, and IFRS 18 does not mandate the use of specific names for the individual financial statement. For example, statement of financial position may be referred as balance sheet. Okay, so I hope it's clear till here. As far as the role of primary financial statement is concerned, so the role of the primary financial statements is to provide structured summaries of companies' assets, liabilities, equity, income, expenses, and cash flow, right? So the users can, number one, op- so the role of primary financial statement is to provide structured summaries of companies' assets, liabilities, equity, income, and cash flows so that users can obtain an understandable overview of this element. Overview of these elements make comparison between entities and between reporting periods for the same entity. Between entities and between reporting entities. Reporting entities for the same entity. And identify areas about which they wish to see they wish to seek additional information and notes to financial statements. Okay, so the primary financial statements are useful that they should comply with the specific requirements of IFRS 18. Okay, in respect of the presentation and disclosure requirements of other IFRSs, IFRS 18 states where other IFRS standards provide presentation and disclosure guidance, including minimum requirement. This need not be applied if does not result in material information where other IFRS accounting standards require the separate presentation of specific line items in the primary financial statements. These requirements need not to be applied if doing so is not necessary for the statement to provide a useful structured summary. Okay. A complete set of financial statements should be provided at least annually. Normally, such financial statements are prepared consistently to one specific date. For example, IFRS 18 also permits entities to prepare financial statement for a 52-week period. That means for every week, which results in different reporting date each year. Any entity may change its reporting date, in which case they will prepare financial statements for a period that is longer or shorter than a year. In this case, it must disclose this fact and state that amounts in the financial statements are not comparable. So far, so good. Now, as far as the consistency of presentation, disclosure, and classification. So, presentation and classification of items. Items in financial statements should be retained from one period to the next unless An IFRS accounting standard requires a change in presentation. Another presentation or classification. Would be more appropriate. Having considered the criteria for the selection and application of accounting policies in ISA. Um, Now, as far as the comparative information is considered, for comparison purposes, at least the preceding period the results must be included in the current period financial statements. So, as far as the numerical information in the preceding period is considered, one disclosed unless and IFRS accounting standard permits requires otherwise. As far as the narrative and descriptive information in the preceding period is concerned, well, included when relevant to understanding. When relevant to understand Current period. Financial statement, for example, a legal dispute. So when the presentation or the classification of a financial statements is amended, if practicable, reclassify comparative and disclose the nature, amount, reason for classification. Okay. So when the presentation or classification of items, financial statement is amended, if practicable, reclassify comparatives and disclose the nature amount and reason for reclassification. If impracticable, disclose the reason for not reclassifying and the nature of the changes which would otherwise have been made. Have been made. Okay. So if an accounting policy is changed for a prior and error corrected, a third statement of financial position is required to be presented as the beginning of the prior financial year. See what I just said. Let me repeat. If an accounting policy is changed, or a prior period error corrected, a third statement of financial position, a third statement of financial position is required to present it at the beginning of the financial year. I hope it's clear till here. All right. So let us continue. Just a second. Yeah. So IFRS 18. Now principles of aggregation and disaggregation. Aggregation and disaggregation. IFRS 18 requires companies to aggregate or disaggregate information presented in the financial statement and disclose in the notes based on the principles, the stated principles, and what are those? Number one, items, you know, assets, liabilities, equity, incomes, or cash flows. Income and expenses should be aggregated based on characteristics that are shared and disaggregated. Based on characteristics that are not shared. Information should be aggregated or disaggregated or disaggregated based on characteristics that are not shared. Aggregation and disaggregation should not obscure material information. So, what is material means material information? Information is material. If it's inclusion or exclusion or misstating it could affect the decisions of financial statements. Now, well, sorry. IFRS 18 suggests that following items may require disaggregation in the notes or primary financial statements, either because they have dissimilar characteristics characteristics or because information is material, right? So, firstly, in statement of profit or loss, what are those? Number one, write downs or reversal of write downs of inventories, impairment, losses, and reversal of property, plant, equipment, income or expenses, relating to Restructuring. Income or expenses. Relating to disposals of property, plant, equipment. Income or expenses from litigation, settlements, non-recurring income and expenses. Okay. In statement of financial position, property, plant, and equipment. Okay, PPE, property, plant, and equipment, disaggregated into IS 16 classes. Into IS 16 classes. Receivables, disaggregated into trade receivables, prepayments, and other incomes. Inventories, disaggregated into merchandise, production supplies, production supplies, materials, work in progress, equity, capital, and reserves. So line items, totals, and subtotals in the primary financial statement should be labeled in a way that faithfully represents the characteristics of the item. To achieve this, descriptions and explanations may be required, including how items have been aggregated or disaggregated. So far, so good, and I hope it's clear till here. So next is offsetting. Now we have to look at the offsetting. Well, as far as the offsetting is concerned, offsetting, either it is assets, either it is liabilities, income, expenses, should not be offset. Should not be offset unless other IFRS accounting standard requires or allows offsetting. Other uh, IFRS accounting standard allow offsetting. For example, IS IS 12, IS 12 income taxes requires a tax liability to be offset against a tax asset under certain conditions. So offsetting, except when the offset faithfully reflects the substance of a transaction, reduces the ability of the users to understand the transaction and the events which have occurred, and inhibits their ability to assess future cash flows, presenting assets net after an allowance. For example, trade receivables net of an allowance for credit losses is not offsetting. Now, current and non-current distinction. So, asset or liability is classified current when it satisfies one of the following criteria. Okay, so an asset or liability classified as current when it satisfies one of following criteria. Now, let us discuss about the assets first. So, the entity expects to realize or consume it in the normal operating cycle. The entity holds it primarily for the purpose of trading. The entity expects to realize it within 12 months of the reporting date. Um, as far as liability is concerned, the entity expects to settle it in the normal operating cycle. It normal operating cycle. The entity holds it primarily for the purpose of trading. The entity expects to settle it. Settle it within 12 months of reporting date. The entity does not have the right has the right at the end of the reporting period To defer settlement for at least 12 months after the reporting, guess what, period. Okay, so it's done as well. Now let us look at the structure of the financial statement of financial position. Structure of statement of financial position. So it is, there is no change in it. Okay, ABC group statement of financial position as at 31st December 2000 X4, for example. Okay, so here 2000 X4, 2000 X3 for the comparison. Firstly, what we will do, assets. In assets, we have non-current assets, right? So it's property, plant, equipment, goodwill, other intangible assets or intangible, yeah, other intangible assets, investment in associates and joint ventures. Then we have current assets, obviously, which you know what are those? Inventories, trade receivables, cash and cash equivalents, other current assets, uh, total current assets, total assets, After that, we have equity and liabilities. Equity attributable to owner of parent company. Share capital, retain earning, other components of equity, total equity, attributables to owners of parent, parent company, okay, NCI, if there is any, okay, uh, non-controlling interest, and there we go, bang, that's the total of it. Then we have non-controlling liabilities, I mean non-current liabilities, warrants, lease liabilities, provisions, defer tax liabilities, now we have total non-current liabilities. Just a second. Defer tax liabilities. Yes, I was right. Total non-current liabilities. Then we have current liabilities. That is borrowings, lease, Liabilities, provisions, provision for goods or services received and other payables. Okay. Yeah. Then payables for goods, services, income tax payable, total current liabilities. Then we get total liabilities and total equity and liabilities. That's the format, it's unchanged. So this format will be used in question in the financial accounting and reporting exams. The terminology used within it is, however, not mandated in, and you should be aware of the payables for goods or services received and other payable is commonly referred to as the trade and other payables. This shorter term is used throughout the, standard. I hope it's clear. So, as far as the minimum disclosures are required, uh, certain items must shown in the statement of financial position if material. The minimum requirement for this line items, the order which is not prescribed, the minimum disclosures are required for property, plant, and equipment, investment property, intangible assets, goodwill, financial assets, financial assets, biological assets, inventories, trade receivables, provisions, deferred tax, provisions, cash and cash equivalents, assets classified as held for sale, NCIs, non-controlling interest, liability and disclose liabilities and disposal groups. So all items of income and expenses recognized in a period must be presented in a single statement of profit or loss, in two statements, that is statement of line items of profit or loss, and the second statement beginning with the profit or loss and displaying items of OCI. Okay, so yeah, presentation now. So all items of income and expenses recognized in period must be either in single statement of profit or loss and OCI, other comprehensive income, or in two statements, statement of line items of profit or loss items of profit or loss. Second statement, beginning with profit or loss displaying items of OCI. So the categories in statement of profit or loss. Categories in statement of profit or loss. So IFRS 18 requires all income and expenses items in statement of profit or loss are classified in the operating category. The investing category. The financing category. The income taxes category. The discontinued operations category. So the general classification required are described. We'll discuss in it. Okay, and these are very if an entity either invests in assets or provisions financing to customers as a main business activity. Okay. Okay. Now, first operating category. All income and expenses that are not categorized are presented are not categorized are not categorized in one of four categories are presented in operating category. So practically, this should include revenue and expenses associated with the normal trading activities such as the cost of goods sold, salaries, other general administrative and selling expenses. It also includes amounts related to property, plant, and equipment such as depreciation, impairment losses, profit or loss on disposal, etc. So what it includes? Well, it includes revenue, expenses, that is normal trading activities. Okay, you know, it also includes depreciation, it also includes impairment, profit or loss on disposal of assets. So, what will be in investing category? So it's associates, you know, associates which will study in consolidation as well. So what's related to it? We will recognize share of profit of associate, cash and cash equivalents, interest income, financial assets. Well, what's in financial assets? Interest income, dividend income, gain or losses on remeasurement of financial asset measured at fair value through profit or loss transactions. Gain or losses on financial assets. Okay. It's also includes investment property. So we will recognize as the rental income related to it in the investment category, gain or losses on investment property, gain or losses on investment property, etc. Okay. Uh, Gain through then we have financing category. So financing category. In financing category, we have various types of liability. And here we have two types of transactions. Transactions uh, involving raising of finance. So it includes debts that will be repaid in cash. that that will be repaid in entities' own shares. Now, other type is transactions not involving only raise of finance, trade tables, contract liabilities, lease liabilities, a litigation provision, government grant. Another category we have income and expenses in financing category. And here, in transactions involving only the raising of finance, it's gain or loss on derecognition, gain or loss on initial subsequent measurement, transaction costs relating to acquisition or disposal, recognized in P&L. So transactions not involving only the raising of finance, it's interest income or expense if this amount arises as a result of applying IFRS accounting standard. So income and expenses which are not, classified in the financing category are classified in the operating category. Okay. As far as the income taxes category is concerned, all income tax amounts relating either it is current tax or the deferred tax are recognized in the profit or loss should be presented in the income tax category. So it includes current tax and deferred tax. Now we have the last category here. Okay. And that is Discontinued operations. Discontinued operations category should include all income and expenses from discontinued operations as required by IFRS 5, non-current assets held for sale and discontinued operations. So, income and expenses from discontinued operations will include in this category. I hope it's clear now and it's very much cool to you. Okay, so far so good.